For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, what do you say? Let's manage that financial future, huh? Why not? The music's playing. The intro has started, which means it's time for another fabulous episode of this program. Welcome, one and all, to the Managing Your Financial Future podcast. I know we have quite a few new listeners, and I will tell you right off the bat that you should subscribe to this podcast. You should do so on your device. You can download this on your device, Apple Podcasts, Spotify, and all that stuff, and I'll remind you a little bit later on in the program that you can do that. And if you're new, we got a bunch of stuff you can download, free things, retirement guides, Social Security guides. We've got a bucket strategy guide, all kinds of things. Go to luciacap.com, LUCIACAP.com, and download your guides. Good stuff, good stuff. Johnny Dean here, your podcast host, and I am joined, as usual, by Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. You need maybe for 2025, Professor, you need to get a third designation. Have you thought about that? Throw me off a little more?
Actually, no, I haven't thought of it.
And that's being charitable. And speaking of being charitable, this is how we're going to slide into this week's topic.
Oh, wow. That was a transition.
Isn't that good? Hey, I'm a professional. Don't try this at home, folks. Don't try these segues at home. I do want to talk about this. Now, we're close to tax time. If you're listening to this podcast when it comes out, we are close to tax time here. In fact, they're due in the next, I don't know, probably 10 days, something like that. But I want to talk about giving and clear a few things up. We had some questions, and this was quite some time ago, about not just charitable giving, which we're going to get to in a little bit, but also what we might call non-charitable giving. We're going to call it gifting, which is kind of it's charitable on your part. If you want to gift some money to somebody, it doesn't even have to be money. It can be, assets of any kind. It can be a house. It can be an expensive car, if you like. But, Professor, what I want to do here is start off with the non-charitable part, and then we're going to slide over into the strategies that a strategy that people have asked us to re-explain. We did this a year or so ago. Maybe it was last summer. I'm not sure. And talk about this qualified charitable distribution, or whatever you want to call it.
So that's going back to the charitable giving side.
Right. That's on the other side. And we're going to cover that probably in just a little bit here, depending on how much time we're going to go through. But we haven't talked too much about gifting and gift taxes. And one of my favorite things to do many years ago was to sort of explain to people exactly what gift taxes are. And I think many people have the idea that if you receive a gift, you got to pay taxes on it. And if they've looked online but didn't look hard, they may have seen that there is a number, there's an amount that you can give every year. This year it's is it 19,000? What is it?
It's $19,000.
Yeah,
the annual gift exclusion.
Right. So if you look and just kind of glance at it, you might figure, okay, well, if somebody gives me $19,000, maybe I don't have to pay tax on it. But then if they give me more than that, I guess I have to count it as income. Anyway, I whatever the misconceptions are, I kind of wanted to clear those up, if we would, or if you would, please, here. First of all, Professor Plum, let's talk about gifting and gift taxes in the non-charitable form. Explain what this $19,000 limit is, and then we'll kind of branch off from there.
Well, there's actually two numbers that are given. One is the $19,000 annual gift exclusion. That has been increasing over the last several years. I remember when it was 14,000. It was 14,000 for quite a while. Then it went 15. Now it's all the way up to 19,000 per person, per donor, per recipient, basically. So we've used the example a lot. If you had put a bunch of $19,000 bills in a package, you got all these different packets of $19,000 bills, and you stood on a corner and you handed them out to everybody that walked by, and you didn't get robbed. As long as nobody got in line twice, you don't even have to account for that anything. You've given up to $19,000 to anybody you want to give. And you're allowed to do that to anybody. You don't have to be related. You don't have to know them. You can give $19,000 per person to any one other person, as long as you don't give more than $19,000. There is no accounting. There's nothing. It's all part of the $19,000 annual gift exclusion. But the misunderstanding comes in that what if I give $19,001? What if I give more than that? And we had this question the other day. Somebody wanted to help their child buy a house. They wanted to give them a big down payment. They wanted to give them $200,000. They're saying, well, how do I do this? Because, I'm a single person. They're a single person. I don't want to have to pay tax. I don't want them to have to pay tax on the $181,000 that's over the limit. And so that's where this other number comes in. There's a lifetime exemption amount. Over and above the $19,000 annual amount that we can give to any one person, there's a cumulative lifetime exemption of currently $13,990,000 per donor. So if you happen to go over the $19,000 number, don't sweat it. You've got $13,990,000 left to go in that year to that one person before you or they owe any kind of tax.
Yeah, that number has gone up considerably. The annual one, that $19,000 has gone up in little dribs and drabs.
It goes up like $1,000 every year or two or so.
If you're lucky, I guess. But that let's call it $14 million. It's just shy. It might as well be $14 million. That $14 million has risen from, it was $1 million. Boy, not that long ago. I want to say 20, 25 years ago. It was about $1 million.
Right. And in 2009, it was $3.5 million. It went up dramatically with the Tax Cut and Jobs Act in 2017.
Go figure.
And then if they don't do anything, it will sunset the end of this year and go back to around $7 million. I don't have the exact number because it's going back to the number that it was previously at in 2017, which was $5 million plus COLA. And I don't know what the COLAs were so it'll be right around that $7 million per person number. Still a decent number, but there are some people that will have to, worry about it that otherwise wouldn't have had to worry about it. But the idea is we get the question that, well, I want to help them out, but I don't want to deal with that. I was talking to somebody the other day. They're worth about, $1.4 million, $1.5 million, and they've got, that's of investable assets. They've got a house, but much of what they're living off of is their pensions and Social Security. They're not drawing down their assets very much. So they can afford to give away assets because they really don't need their assets. I know it's a horrible place to be in, but they're in it. And so they're going to give their kids some money to help them with their first-time home purchase. And they're worried about the gift tax. I said, don't worry about it. They go, what if we go over the $19,000? It doesn't matter because you're not expected to ever be worth, between you and your spouse, basically $28 million. And they don't play the lottery, so that's not going to come into play. They're not going to inherit any money that they know of because nobody in their circle of family has any money that's going to be significant coming their way. So it's unlikely they will ever be worth more. Even if the estate tax reverted, they're not going to be worth more than $14 million. It's just not going to happen. So them giving the money away, it's not going to affect their gift taxes today or their estate taxes in the future because they're well under the limit.
So when we talk about giving money away, gifting money to people, to anybody, technically, if you give more than this year, $19,000 to any single individual during this calendar year, you are technically supposed to fill out this form 709 and let the government know that you've eaten away into that.
Some of your lifetime exemption.
Right. Let's call it the $14 million. So if I gave $30,000 to one person, the way it's supposed to happen is I get $19,000 I can give away, but I gave $30,000, so there's $11,000 more. So I'm supposed to fill out Form 709 this year. I'm supposed to tell the government, hey, call it $14 million exemption needs to be lowered now by $11,000. So I've got $13,989, well, if I did that right, $1,000 left to give away tax-free.
During my lifetime, over the 19,000, or at my death.
Right. Now, of course, that 13, 14 million could go up. But anyway,
it's set to go up every year if it stays, if the law stays in place. And even if it reverts back to the lower number, it's set to go up every year with the cost of living. We'll see what Congress actually does. But this is one of those things. Now, if the people I were talking about that were worth, call it $2.5 million with their house, $1.5 million in investments, $1 million house, and they're giving money away. If they give away a couple $100,000 to their kids over the 19,000 per year, do they really? No, I am not a tax preparer, so don't take my word for it. Talk to your tax preparer about this. But what I have heard is that the IRS doesn't want to hear, it doesn't want to see another piece of paper for somebody who's never going to have an estate tax in the first place. Yeah. So even if you want to file it, file it. But you're never going to be worth, unfortunately, you're not going to have that problem. Most of us are not going to have that problem that we're going to be paying estate taxes. Now, on the other hand, if you are $40-50 million individual, you go over the 19,000, yes, they're going to scrutinize you, and they're going to find a way. You better be filing those tax returns to tell the IRS what you're using, what you're not using.
Yeah, you don't. I mean, there are athletes and a lot of very wealthy people who will have to worry about this. But for the average person, there's no gift tax. If you receive a gift, in almost no case will you ever have to pay a gift tax, even if you get a $10 million gift. I mean, the
gift tax is payable by the person who is making the gift, not by the person receiving the gift. So if somebody gives me $10 million, it is not necessarily, there is a small caveat to that, my issue to pay any taxes, gift taxes on that $10 million gift. It's the person who gave it to me that's going to be subject to, if they were over the limits, subject to paying the tax. It's their responsibility to pay a tax. The only time this comes into play is like if somebody's already exhausted their $14 million exemption and they're going to give a big donation away, and they basically bankrupt themselves. They've already given away everything. They have no lifetime exemption left. It's all been used up, and they have $10 million left. And they want to give that $10 million away, and they have no money left to pay the taxes. At that point, they'll go back to the recipient and say, okay, pony up. But that's the only time that the gift tax is going to be paid by the recipient.
Yeah, and I never studied these cases. I don't know that it's ever happening. I don't know that it's ever happened. I guess the main point with this is that if you're concerned about gift taxes, as a couple of people were that had just asked us about this, it's unlikely you're going to have to worry about it.
Now, I did have somebody say, you know what, I understand the lifetime exemption, this, that, and the other thing. I do not want to use any of my lifetime exemption right now. I want to give my kids $100,000 each, well, $120,000, but I don't want to use up any. For whatever reason, they were adamant. They didn't want to give up any of their.
They didn't want to eat into that $14 million per person.
Depending upon what's going on, if the person you're giving it to does not have any investment income, they don't have any capital gains, they don't have any interest earned, they don't have any dividends, none of that. I can give up to $100,000 to somebody as a gift loan and charge them no interest, and then basically forgive it over the next 5+ years as part of the 19. So I forgive $19,000 every year. But if they have investment income, if they take that $100,000 and they turn it into an investment that's earning income, now I can't not charge them interest. Even if I don't charge them interest, the IRS will impute interest and charge me taxes on the interest, because this is a way to get away from, because back in the day, very wealthy people would take large chunks of money and give it to their 3, 4, 5-year-olds. This is before kiddie tax stuff, and the kids would be making a lot of money and to be paying taxes at the kid level versus the parent level. And so they put this law into place, the gift law and all that, the gift loan, to avoid income shifting during different times. And so forget the kiddie tax. If I give my kids $1 million, and they turn it around and make $50,000-$60,000 a year in interest off of it somehow, I have to charge them interest on that loan, because otherwise I would have had the $1 million in my account making interest, and I would have had to pay tax on it. So Congress is like, no income shifting here. But it's not that big. Most people don't have to worry about this.
Yeah.
Because the limits, even at the 7, the limits are high enough that most people don't have to worry about it. But when it's almost $14 million, very few people have to worry about estate and gift tax. Now, whatever I don't use of my lifetime exemption during my lifetime, I can use at my death. Whatever I have used during my lifetime, obviously I can't use when I pass away. So if I were to give $13,990,000 of taxable gifts today, I don't actually owe any physical dollars out of my pocket, but I've used up my whole exemption. That means when I die, everything's going to be subject to the estate tax when I die. Estate tax being 40% at that point.
Yeah, estate taxes are quite high.
Now, gifting, if somebody gives somebody $50,000, the person that gives it does not have a gift tax. The person that receives it does not have an income tax, doesn't have a gift tax, doesn't have an income tax. These are two different systems, though. The income tax and the gift tax are two different tax systems. And so people get confused about what's going on. And okay, you told me there was no gift tax, but if Grandpa gives me $50,000 worth of pick a high growth stock, Microsoft, that he paid $10 for back when it first came out. I don't owe any taxes? Well, no, that's different. You don't owe any gift taxes, but if you sell it, you would owe an income tax.
Yeah, because
gain tax.
In that case, there's no step up in basis.
If you're making a gift during your lifetime, the basis of that asset travels across to the recipient, assuming there is a gain. So the gain goes across to the individual. That doesn't work if you have a loss. You cannot gift a loss to somebody, but you can gift a gain. So you just have to be worried that, yes, in that example, there was no gift tax, but when that recipient sells that, there would be an income tax.
Yeah. And, if
a capital gain in this case.
And for people who are just kind of saying, wow, wait a minute, it started off fine, but now I'm getting real confused with all these numbers and everything. Honestly, let me just back this up, and we're going to talk about qualified charitable distributions, QCDs, in just a moment. But the upshot of all this is, if you were concerned about a gift tax or an estate tax, unless you're worth more as a married couple now, we're going to say more than $28 million at this point in 2025, you're not going to have a problem with that. And
we are assuming that you're making the gift to a U.S. citizen.
Okay, well, we got to throw in all the little asterisks here. But that's true. That's true. So just keep that in mind. There's generally not going to be a problem with that. Okay, so that's the, as we said, the non-charitable side of giving. But let's move this over again, because we had a question last week from someone who was asking, can you please explain this whole idea of qualified charitable distributions, QCDs? Now, I do like to talk about these because now we can, ever since, I don't know, when did they make these permanent? It wasn't that long ago. But we know going forward that you can do this. So, Professor Plum, please give us the lowdown, if you would, on qualified charitable distributions, or as they call them, QCDs.
Well, a lot of times seniors do not itemize. In fact, a lot of people don't itemize the way things are going right now. And a charitable contribution is a deductible expense if you itemize. If you don't itemize, you don't get the charitable deduction, or you don't get the whole amount of the charitable deduction. The itemized deductions have to be more than your standard deduction before anything becomes deductible, and then only the amount over the standard deduction is really deductible. So what if I don't have enough standard deductions and I want to make that $5,000 gift to church or charity, whatever, wherever I'm giving it, and I'd like to get a deduction for it. I mean, I'm making the gift because I'm charitable, but I'd like to get the little ancillary benefit as well of that tax deduction. Well, for people who are at least 70 and a half years of age, and this is to the day for 70 and a half, they can have money taken directly from their traditional IRA and sent to the charity directly. It doesn't go to your bank account. It doesn't stop go. It doesn't. You don't pass go. You don't collect $200. It goes directly from your IRA to the charity, and you can give up to $108,000 this year this way. one of the benefits of it is this will satisfy or count towards your required minimum distribution when you're old enough. So it can help you, for people that have large required minimum distributions that they don't need, and they're charitable, this can help them reduce the taxability of their overall income for that year. It is not an itemized deduction. It doesn't show up on the Schedule A. It actually reduces the adjusted gross income. Reducing the adjusted gross income it could potentially reduce your IRMA. It could reduce the taxability of your Social Security. It could increase the deductibility of your medical expenses. There's a lot of things that trigger off of adjusted gross income. So by making this contribution deductible above the adjusted gross income line so that your adjusted gross income goes down, can have some nice benefits.
Yeah, the issue was this. People would have a certain amount of money they wanted to give to charity, and they say, okay, well, I've got, let's say, an $8,000 required minimum distribution, whatever it is. And they say, okay, well, I'd kind of like to give that, let's say I want to give the whole $8,000. I don't need the RMDs. I don't need the money. I'd like to use that, and I'd like to give that $8,000 to my favorite charity or charities. So what people, if you don't use the QCD, what people will do is they will take the $8,000 required minimum distribution out of their IRA.
Shows up as taxable income.
Yeah, it goes on your tax return, of course, because that's income to you. And you say, okay, but I'm going to write an $8,000 check now to this charity. So the income comes in, I claim it, but then I'm writing an $8,000 check. So supposedly I should be able to deduct that, and it should be a wash, and no problem. But there is a problem. Now, one of the ones you mentioned
can be a problem.
Well, there can be a problem. Yeah, I think for some people there is. As you said,
if you don't itemize your deductions, you don't get that deduction of the $8,000, so it doesn't wash.
Right, and that was the first thing I was going to say. As you said, the number of seniors who actually do itemize, I mean, they may not even be able to do that. So now you got an $8,000 income, and you got no way to counteract that. But even if you
can deduct it, but your Social Security is not fully taxable at the full 85% mark, yes. You take the $8,000 in from the IRA and you write a check. You put it in your checking account, turn around and write a check to the charity. That washes the $8,000. But that $8,000 additional adjusted gross income could have subjected up to $6,800 more of your Social Security to taxation than was there on the taxable column before. So you still have to pay tax on that $6,800 of Social Security that wasn't taxable before. That raised your taxes. So it just affects everything. Or maybe that $8,000 puts you into the IRMA limit, the income-related monthly adjustment amount. Even though I got to deduct from my income taxes, my taxable income, the $8,000 gift to charity, even if I could deduct it, my adjusted gross income was higher, my total income, because the IRA distributed it to me, and now maybe it put me over the IRMA limit by $5, and now I get to pay more for my Medicare 2 years from now.
Yeah, you said IRMA, IRMAA, as you said, is the income-related monthly adjustment amount. Just remind people or tell people who don't know what it is you're talking about when we say the IRMA limit.
Well, when you're on Social Security, when you're on Medicare, I should say, there's a premium for Medicare or for Medicare Advantage. You are paying some dollar amount out of your check. They just take it out of your check before they deposit your bank account, your Social Security check, every month. And normally, the premium right now is like $185 for Medicare Part B. But if you make too much money, if you make over certain thresholds, $106,000 for a married couple, $212,000 for a married, or $212 for a married couple, $106 for a single individual, adjusted gross income before deductions, then you get the privilege, the benefit of paying more for your Medicare premium. How much more do you get to pay? Depends on how high you go on that income level.
Sometimes it's a lot.
It up. It can get very high if you have a lot of income. That Medicare premium can go up quite a bit. And so the Medicare premium could go as high as almost $630. So from $185 to 630. Now, you got to have a lot of income to go that high, but it starts going up pretty quick. It goes from 185 to 259, from 259 to 370. Now, it only goes up for a year, and it goes up 2 years after that income happens. So if you only have a spike in income 1 year because you sold an asset and you had a big capital gain, that will affect your Medicare premium for 1 year, 2 years from now when they match everything up. But if you're consistently over that level and you're going to pay a higher premium consistently for 2 years later for all the things. I mean, the reality is the Medicare premium at 185 that we pay when we're on Medicare is actually only 25% of the true cost of that Medicare premium. And they say, well, if you make too much money, then you deserve to pay a higher percentage of the premium. The government pays 75%, you pay 25%. Well, if you go over the 106, but you don't go over 133, you get to pay 35%. If you go over the next threshold, you get to pay 50%, 65, 80, as high as 85%, that's a common number out there, of your Medicare premium because you're rich. You know, you may not feel rich, but your tax return said you had a decent income, a very decent income in some cases, and therefore you get to pay more for that Medicare.
Yeah, that's the IRMA that you were talking about, and as you said, that required minimum distribution could punch you into that, and it's happened before. It may not put you up, to the highest realms of the IRMA, but it does.
Even a $74 increase per month. And if you're married per person, well, let's start adding up a little bit here.
Well, it's $150 a month, $148 a month in that example. It does add up, and over the course of a year, that's
$1,800 of additional premium for the exact same coverage you were getting for the lesser premium.
Yeah, so why not try to avoid that? So what the qualified, we'll call it the QCD, the Qualified Charitable Distribution process does, is it keeps that required minimum distribution from ever going on to your tax return. You bypass it completely. Now, as you said, I believe you said this, you need to make sure that the IRA custodian sends that donation, whatever it is that you're taking out of your IRA, directly to the charity. It doesn't go to you. They write a check to the charity, and it's sent directly to the charity.
Now, one of the things that I think Congress did on purpose was, and we got a lot of calls during tax season for this, when people were getting their tax forms and getting ready to do their tax returns. They said, my 1099 does not show that we did a QCD. My 1099-R does not show the QCD. And so they want to have the 1099 reissued with the right number. So, they may have taken $20,000 out of their IRA to live, but they also gave $10,000 through a QCD. So they only want the $20,000 to show up on the 1099. Well, the reality is there is no code. There is no accounting on the 1099 for a QCD. In that example where 20 I took out to live and 10 I sent to the charity, my 1099 is going to show $30,000. Mm-hmm. And it's going to show all of it as just a normal distribution. Now, if all I do is hand over all my information to my tax preparer and I don't tell them they did a QCD, I'm going to pay tax on that $10,000 gift that I made to charity because the tax preparer didn't know you did a QCD, and that there's nothing. And we can't have the custodian reissue a 1099 that shows it because there is no way to show it.
So what do?
You tell your tax preparer or you tell your tax program when it asks you, did you give any of this money to charity? And it will account for it correctly. What it does is it will account for the $30,000 as the box 4A. It says, yes, did you receive any money from your, out of the IRA? Was any money distributed out of your IRA? Yes, $30,000. And then over on the right-hand column, the taxable column, it'll say how much of that $30,000 was taxable. Well, in my example, I put a 20 there. $20,000 was taxable. And between the two lines, I put a little QCD that says, Mr. IRS, the reason that these two numbers don't match is because we did a QCD for $10,000.
So take a hike is what you're saying. Okay, good. Well, okay, I wanted to, you want to add one more thing?
One more thing. A lot of people think that they have to do the first thing in the year, before they take any money to live, they have to send money for a QCD because it's the required minimum distribution. And the required minimum distribution is the first thing you take out of the IRA for the year. So if you're 73 years old, soon to be 75, the QCD counts towards your RMD, but it doesn't have to be equal to the required minimum distribution. It can be any amount of the required minimum distribution. If you've got a $30,000 required minimum distribution, any amount up to $108,000 total can be used as a QCD. It can be less than, it can be $5,000, it can be $10,000, it can be anything you want up to the maximum for that year. And it does go up every year with inflation. So it's not the RMD that you're giving away, but the amount you're giving away counts toward the RMD.
Yes, and where I think, at least personally, where I've seen this a lot, and maybe you have too, people may have a $10,000, $12,000, $20,000, whatever it is, required minimum distribution. But, the only charity they really give to, let's say, is their church every week, and they give $50 a week or whatever it is. Well, that's $2,500, $3,000 a year. You could just take that directly out of your IRA as a qualified charitable distribution and at least get, some of that off your tax return.
Right. I mean, and the reality is trying to do a QCD at $50 a week is very difficult. You don't want to do $50 a week ones. I mean, just the paperwork's no fun. So you figure it out. You say, okay, $50 a week, 52 weeks, that's $2,600. I'm going to make a one-time gift to the church or the charity, the school, the zoo, the whoever, for $2,600.
Yeah, and
done for the year.
And we like to say that. We like to say because if you get, especially for the church, if you want to give it to the church, you do it all at one time so you can get it out of the way, and then you just tell everybody when the collection plate comes around, I gave, this was a QCD, so I'm not just passing the basket away.
That's not as big as it used to be because a lot of this is tithing is done, online anyway. So,
is it?
You don't have to feel bad that you're passing it along and not putting any money in, because most people, the regular people going there, probably haven't set up an auto deposit or auto deduction every week anyway.
That's probably true. They don't have a card reader going by, do they? I don't think they do. Anyway,
Venmo it.
Venmo it. Yeah. Hey, Professor, thank you so much. This is good stuff. I wanted to, as I said it before, I wanted to clear this up. The gift tax is always confusing, and the QCD is often confusing. And I hope we cleared that up for certain people. If you were one of those, I hope we did that for you. I want to remind everybody that if you'd like more on this, you want to find out more information about this, you can go to luciacap.com, LUCIACAP.com, and we got all kinds of articles there at that place. You can download, as I mentioned before, at the top of the podcast, we have guides. We don't really have a QCD or giving guide, but we have a bunch of other guides you might want to be able to check out for free. Download them. And speaking of downloading, once again, download this particular podcast to your device. Subscribe, Apple Podcasts, Spotify. Both of those places. If you want to get in touch with Professor Plum or any Lucia Capital Group advisor, give them a call, 800-644-1150, 800-644-1150. If you need a bucket strategy, if you don't have one, I highly suggest, I would almost urge you to get one. 800-644-1150 and talk to the people at Lucia Capital Group about that. I should tell folks, let's see. So this is like episode 14 of this season, and I put that word in quotes. So we've got 2 weeks after this. We will not be on live. We will resume after that. We'll do our usual, in-season hiatus, whatever it's called. We've been doing this for a long time. But I wanted to let people know if you download it normally and want to hear it exactly when the episode drops. We're going to have 2 weeks where we don't have an episode, but then we'll be back. We'll be back right after that with more great stuff. Professor Plum, thank you so much.
Welcome.
I always appreciate it. Nice to have you here. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, I'm your podcast host, Johnny Dean. Thanks so much for listening. Managing your financial future. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Information on investment products is for informational purposes only and does not constitute an investment recommendation or a solicitation to buy or sell the investment products described herein. IRA IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.